Hi and welcome back to another episode on Forex trading. Today we're diving into one of the most influential factors in the Forex market, the interest rate. Understanding how interest rates work and their impact on currencies can make a huge difference in your trading success. So what exactly is the interest rate and how does it shape the market? Let's break it down. We'll start with the basics. The interest rate is essentially the cost of borrowing money or the reward for saving it. It is set by a country's central bank and serves as a key economic tool to regulate inflation, economic growth, and financial stability. In the Forex market, the interest rate is a critical indicator that helps traders assess the relative value of different currencies. Generally, higher interest rates attract more investors, strengthening the currency. On the other hand, lower interest rates can weaken a currency's value. So, how do interest rates affect inflation? Well, as surprising as it may seem, interest rates are one of the most effective tools central banks have to control inflation. When interest rates change, they directly impact borrowing, spending, and saving patterns, influencing overall economic demand and inflation. Here's how. When interest rates increase, borrowing becomes more expensive for individuals and businesses, leading to reduced spending and investment. As demand slows, inflationary pressures ease and prices stabilize. Higher interest rates also make saving more attractive, further reducing spending. When interest rates decrease, borrowing becomes cheaper, encouraging spending and investment. This increases demand in the economy, which can drive inflation higher. Central banks often lower interest rates during recessions to stimulate economic growth. These changes affect not only a country's domestic economy, but also its trade and currency relationships globally. Higher interest rates generally attract foreign investors, boosting the currency's value, as well as reducing imported inflation. Now, let's look at the relationship between interest rates and the US dollar. The dollar's value is heavily influenced by the interest rate decisions of the Federal Reserve. When the Federal Reserve raises interest rates, the dollar often strengthens as US financial assets become more attractive. Conversely, when the Federal Reserve lowers interest rates, the dollar tends to weaken as investors seek higher returns elsewhere. For Forex traders, monitoring interest rate changes by the Federal Reserve is crucial, as these decisions directly impact currency valuation and trading opportunities. Next, let's talk about gold. Gold is often considered a safe haven asset, and its value reacts differently to interest rate changes compared to currencies. When interest rates rise, the demand for gold often decreases because higher yield financial assets, such as bonds, become more appealing. And when interest rates fall, gold becomes more attractive as investors look for stable assets during periods of low returns. As such, interest rate fluctuations play a key role in determining gold prices, making them an important consideration for traders. Okay, so now you know about gold and the US dollar. But how about cryptocurrencies? Well, even Bitcoin, which operates outside traditional monetary systems, is not immune to interest rate changes. When the Federal Reserve raises rates, demand for riskier assets like Bitcoin often decreases, leading to potential price drops. Conversely, lower interest rates can boost the appeal of digital assets such as Bitcoin, as they offer alternative investment opportunities in a low-yield environment. As you can see, interest rates affect a large variety of different assets, which is why knowing when they're announced is vitally important. Central banks, including the Federal Reserve, announce interest rate decisions on scheduled dates throughout the entire year. For the Federal Reserve, these announcements occur 8 times annually during Federal Open Market Committee or FOMC meetings. Each meeting lasts 2 days, with the final decision released in an official statement. A press conference by the Federal Reserve Chair often follows to provide further context. Institutions like the European Central Bank and the Bank of England also announce interest rates regularly, with schedules set at the start of the year. These announcements are highly anticipated and can cause significant market movements, presenting both opportunities and risks for traders. That said, it is rarely enough to just wait for the announcement. Instead, some forecasting is required, which involves analyzing various economic indicators such as inflation, unemployment, and GDP. Central banks consider these factors when making interest rate decisions, and economic analysts use them to predict potential changes. For traders, understanding these forecasts is essential for planning strategies and capitalizing on market movements driven by rate announcements. So, in summary, suffice it to say that interest rates are a cornerstone of financial markets and have far-reaching effects on forex trading. By understanding how they influence inflation, currency values, gold, and even Bitcoin, you can make more informed decisions. Staying updated on interest rate announcements and forecasts can provide you with a significant edge in the market. That's it for me for today. Thanks for tuning in. If you found this episode helpful, don't forget to like, share, and subscribe for more insights into the world of Forex. Thank you, and see you next time.